Hi everyone, this is Lee. Today we're going to go over weekly market analysis for last week and see what we can learn, maybe help us in our trading for next week. So the market started off this week pretty strongly, and then they were thrown off course Wednesday afternoon during the after-hours session when Facebook, or Meta platforms, I should say, delivered an absolutely terrible earnings report. This earnings report was kind of showed that the management had strayed away from the core focus of their core apps on Facebook and Instagram, and instead they're really gambling everything on this metaverse. It kind of makes them look desperate, like they think that the competition is kind of eating their lunch, from TikTok and other social media platforms, and that they're kind of doing this Hail Mary almost over to the metaverse, which has received almost universally negative reviews everywhere I've looked. So, and their stock tanked 26%, which brought down all the other indices with it. Anyway, let's kind of look at the big picture here. So every index did manage to close green this week. They are all still down substantially for the year, especially the Nasdaq. It has been kind of a rude awakening, as we can see in the charts. From 2021, very low volatility. There was a little bit here and there. This was about a 5% correction for reference. So far, the correction uh, from about 48.18 to about 42.23 at the very low last week's on Monday. That's about a 12.5% for the S&P 500. The Dow was just about a 10% total correction, and the Nasdaq was almost a 19% correction. And that the high actually for the Nasdaq was in earlier in November. And so this correction so far, if this is the bottom, the Nasdaq barely escaped bear market territory here. Anyway, so this was mostly still kind of a rebound week. Last week was a pretty choppy, trying to find the bottom, chopped around, didn't really recover, kind of sideways week until Friday. There was a pretty strong movement upwards in every index on Friday, and then this week, Monday, Tuesday, and Wednesday, all were green days for every index. Pretty strong green days too, with every index finishing near the high of the day. It all looks great. It had a lot of people fooled, perhaps, that this was going to be another V-shaped recovery that we've become so familiar with since the quantitative easing era, especially since Jay Powell became the Fed chair. Um, Almost every drop has been kind of one of these V recoveries, even the bigger ones like COVID-19 dropped 36%, recovered in just a few months. That's unheard of. Even compare that to the October 1987 crash, there was not a V-shaped recovery, about the same 36, 37% down there, but it took over 2 years to recover. So anyway, we've become used to never any bearish movement really gaining any momentum and follow through and since 2009, and that won't last forever. That's what we're here to figure out is when that regime shift is changing. So let's start here with the Nasdaq, or I mean with the S&P 500. So basically, after last week's low at the top here on Wednesday, had retraced almost like about 8.9% from here to here. That's a pretty substantial. It crossed the 200-day moving average last week, closed below it, chopped around below it. Then it strongly pushed above it and strongly pushed under the lower weekly Bollinger Band here. Didn't quite reach the middle weekly Bollinger Band. And then that rug pull came kind of after hours on Wednesday when Meta Platforms released that terrible earnings report I was alluding to earlier. That sent Facebook down 26%. Facebook is about a 4% weight in the S&P 500, or at least it was before that drop. So that had a direct impact. And then plus, I think the fear is that when mega cap tech stocks that are worth nearly $1 trillion, when they can go down way into the double digits, 26% in a day, that's kind of unheard of. Losing over 250 billion in market cap in a single day, that just kind of sets investors off on it unnerves them to a large degree. You can see it most clearly in Nasdaq, of course, where Meta Platforms is much bigger than 4% weight, or at least it was. There's a humongous gap down here. These, by the way, are the index charts, not the futures charts. That's why you see such a huge gap down here, where the Nasdaq opened on Thursday after that terrible earnings report, nearly erasing, basically did erase all the gains from this week on that report. But then Amazon did come through on Thursday after hours. They delivered a report that sent the stock at one point up 18%. It closed Thursday up 13.5%. Honestly, I was pretty surprised. The report that Amazon put out did not look very good to me. They barely beat on earnings. And they did not beat. They missed on both revenue and the revenue expectation from the analysts for next quarter. And honestly, the only reason they beat the earnings is because of this one-time windfall from its Rivian electric vehicle investment, which they've already kind of lost because at the time that they closed their fiscal quarter, Rivian was trading at 90 something dollars a share. Now Rivian is 60 something dollars a share. So they've already kind of, if they had reported now, they would have missed earnings as well. But anyway, the stock had been down in sympathy with Facebook and perhaps out of investor fear that their report might be similarly terrible. And so anything looks good compared to Facebook's report. So Amazon's report that was mediocre looked fantastic compared to Facebook's report. So basically, yeah, I guess, and also Amazon had been the weakest of all the mega cap tech stocks since about mid 2020. It had been pretty much flatlining after a really big jump in the early stages of COVID-19, and then it's been kind of flatlining. So I think a lot of it was probably priced in. Amazon, even after this big rally, is still well below its highs set for last fall. That was nearly $3,800 per share. I think after the rally, it's around 3,100, 3,200, something around there. But anyway, that briefly helped a little bit in the Thursday after hours, but by Friday the morning, every index was already down again, and this was before the jobs report was released. So the jobs report on Friday morning was much stronger than expected. Most people thought that this jobs report was going to be pretty weak with Omicron uh, variant affecting the employment market, which it didn't really seem to do. And actually, December was revised upward as well. So this kind of, and we're in this weird stage of the market where good news is sort of seen as bad news to the market because good news like the economy improving and the jobs market tightening and everything like that, that's good news for most people. But the problem is the Fed sees that as the economy has a risk of overheating and adding even more pressure to prices. And we know the inflation rate's already at a high since 1982, about 7%. So this kind of a really strong jobs report pushes the Fed's hand and is probably going to make them have to raise rates and maybe do the quantitative tightening earlier than expected. And that's why immediately when that report was released, every index fell. The S&P 500 almost went back to its 200-day moving average. But then as we've become accustomed to, Fridays have just been bullish days for at least the past 18 months. It's been by far the most bullish day of the week. So I think that that and plus just people hoping that the worst is behind them from last week, maybe after that 200-day moving average test. And the market's kind of resumed upward for the majority of the day after that morning drop. And they all closed in the green, except for Dow was kind of barely red on that Friday. Um, but the problem was the last 30 minutes of the trade, as you can see, there's a really long wick here in the S&P 500 in particular, and the NASDAQ, you can see it here as well. And on the Dow, every index is a long wick because the last 30 minutes of the day was extremely bearish. It raced the last 3 or 4 hours of bullish price movement. And the only explanation I can have for that, there was no new news or anything that I saw. I think people are just a little more nervous. They're a little nervous to hold over the weekend in this environment. I think they think that the bullish momentum, there was some resistance up here that it wasn't able to cross, and that has a lot of people thinking that it's quite possible that we go and retest these lows from last end of January last week, and that would be quite a substantial drop still because there's been a decent rebound. So a lot of people don't want to be in the market if it potentially drops all the way back down to here. What I'll say is I do think there's going to be at least some drop next week. I don't know if it will all the way retest the lows because that is still a pretty substantial drop at this point. The bulls should be looking for on the S&P 500 for 43.50 to hold. As you can see, we have a lot of support from all that chopping around last week around that area. So 43.50 is kind of a must hold level for the bulls. Otherwise, we definitely are going to kind of see this low retested, and that this low needs to hold, or we're pretty much on our way to bear market territory, especially in the NASDAQ. if this low does not hold for NASDAQ, it's almost a certainty we'll hit the bear market 20% threshold, because this was already about 19% down from the highs. So that's kind of where the indexes stand. They're all of them are, well, let's say the NASDAQ is the only one below its 200-day moving average. The Dow and the S&P 500 are still above that critical moving average. So it's still kind of a tug of war right now. Let's look at the weekly economic statistics. So we already kind of talked a little bit about the jobs report being much better than expected. And so that's where you can see in these numbers, and that had a lot of people fear. Because of that jobs report, the 10-year Treasury yield surged over 1.9% all the way up to 1.92 on Friday. And so this is bad news for equity bulls, because interest rates kind of are like gravity to stock market valuations, because investors are always weighing in their mind, should I invest in bonds to get this yearly guaranteed but lower return, or should I risk my money in something that could crash? We've had crashes of up to 90% in the stock market before, something that could crash, but over the long term has performed better than bonds. And so this is what investors are always trying to figure out: should I invest in stocks or should I invest in bonds? And so as the yield on treasuries, and therefore also kind of highly correlated with corporate bonds and everything else, goes up, that makes bonds look relatively a lot more attractive and equities less attractive. And so that kind of has a gravity weight, like pull it as this goes up. Basically, as bond yield goes up, stock market valuations go down, PE multiples get compressed. And so we can see here that we have the 3-month Treasury yield is still very low, and the Fed funds rate is still very low as well, because they haven't started raising. But we've seen on the dot plot that they have big plans to raise 3 or 4 times this year and into next year. They think the long term, they want this to be like 2.5% is what the majority of the members of the FOMC think that this rate should be. And so that is much higher than we are right now. It's still basically zero bound right now. So the S&P 500 valuation, we have the PE ratio at 25.66. That's pretty historically high, but this is the one that's really, really dangerous. So the Shiller PE at 37 is near the highest rating in history. I believe 44 is the highest it's ever been, and that was back from the peak of the dot-com mania in March 2000. Shiller risk premium is basically it's a measure of how much investors are willing to value equities above bonds, basically, because it's like if you take this Shiller PE and you take the inverse to get the earnings yield. So if on the regular earnings yield would be close to 4%, because you think how many times 100 divided by 25 would be about 4. 37, I mean, I can't do the math in my head right now, but basically you take 100 divided by 37 and then subtract the 10-year yield, and that gives you this risk premium. So this number is incredibly low. This means that equities are very risky compared to bonds right now. This means that investors are way too bullish, at least like I have been, and so they've pushed prices up too much. This number, I don't know what the historical low is, but it very rarely goes much below 1, and 1 is usually where bull markets peak long term. So this is this column here shows that equities are in a dangerous, precarious position and could easily have one of the worst bear markets of all time. I mean, just based on valuation, not anything about the economy. So maybe stocks can stabilize and grow into these valuations one day. If the earnings denominator here goes up a lot, then these numbers can look better. But anyway, so we have the sentiment down here. We've got bulls did gain this week. Last week this was about 21 or 22%. So this going up a little bit. This is still well below its normal, is around 38% on average. So definitely sentiment is still bearish, which you would kind of expect for a market that's just had a 12% to 19% drawdown. This can also be often this is kind of a contrarian indicator though. When this gets really low, like say 15% bulls, it's most likely a bottom is near, kind of like CNN's fear and greed index. But anyway, this is still something to keep an eye on for. When it's kind of below average but not really low, it typically tends to be a little bit more of a bearish indicator. And then when it gets really low, that tends to be a contrarian bullish indicator. So at this point, 26 is kind of a bearish number. And so let's look. Yeah, basically that's kind of all I wanted to touch on today. Just a little bit about our models, and this is what we've been building these algorithmic trading models to try to figure out when to get in and out of the market or when to hedge your positions for long-term investors. We have 3 completely free models here that you can find. They've all beaten the S&P 500 over the long term. And then we have 4 premium ones that are more advanced. And so these are pretty affordable models. They combine more indicators and they use more advanced and sophisticated heuristics and machine learning to come up with their signal generation. And you can see the CAGRs here are much better than the market. If you click on each one of these, you'll learn a little bit more. You'll see the drawdowns and whatnot are also pretty better, and you can learn more about the indicators and how the signals are generated. Last thing I'll say about all of these, none of these are high frequency trading models. This is the most TAMR basic, mean reversion basic is the most frequently trading one, and it still only trades about once a week or once a week and a half or so. Most of these trade every 2 to 3 weeks on average. So these are really easy to follow. A good way to get better risk adjusted returns than buy and hold over the long run. All right, that sums it up for today. Good luck to all investors, and I hope you all have a great weekend. Thanks.